Good morning. I'm Tim Nyland. The Fed released its latest Beige Book last week on Wednesday, the 20th. And today we're going to look beyond the book and put all of this into perspective with 10 Zacks Advisor Tools economic charts so that we can begin formulating our 2022 market strategy. Before we get started, please like, comment, and subscribe and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. If you'd like to do the kind of analysis you're going to see in this video, then you're going to need to have a Zacks Advisor Tools subscription. Let's go ahead and get started. This week, we're just going to do things a little bit differently. I'm going to go ahead and tab over to the Advisor Tools platform itself to show you where all of these charts that we're going to review today are actually located. Beneath the charting menu under Fundamental Chart, you'll see the option to select an action here in the upper left. Pull the list control down, you can open up our library. And here you can see user default saved charts as well as the Zacks default saved charts. And if you scroll to the bottom, any of the charts that are prefixed with US are going to be the charts that we review today. There's one additional chart up here that I've made available today. It's called the 10-year break-even inflation rate. And so if you are a Zacks Advisor Tools subscriber, you can access these charts anytime after the webinar. I just wanted to take a quick moment to remind everyone that Zacks offers a full range of custom-built ETF model portfolios as well, and that's for every investor style. Our ETF model portfolios are designed to make asset allocation easier and to seek out performance based on the Zacks ETF rank, as well as fund-specific factors, including expense ratio, ETF holdings, and bid-ask spreads. Each quarter, we rebalance asset class allocations to optimize performance and mitigate risk. We've just done that, and our Q4 rebalance report is available. To get a free copy and to see what we've added and dropped across all of our ETF model portfolios, go ahead and follow the link in the description below. Just to give you an idea of where these are located, beneath the Zacks Research menu under ETF model portfolios, you'll find that option. If you are a current Zacks Advisor Tools subscriber and you do not see your ETF model portfolios option, go ahead and reach out to your sales representative or your account management representative, and we can see what we can do about getting you enabled for those. So let's go ahead and move on with today's webinar. And what I did, the Beige Book was released last Wednesday. I combed through the journals over the last week or so, and I only really found one piece of commentary in the Wall Street Journal related to the Beige Book, which is quite surprising. And it actually mentioned one of the things that I noticed out of the Beige Book to be a real bright spot, and that was this concept of the continued rise in consumer spending. And I have that here highlighted in yellow. It says it grew in most parts of the country, and it also flagged manufacturing activity also having increased. And this kind of coincides with a lot of the charts that I've been looking at as of late. So I figured this would be a great topic to discuss and actually put some historical context in together with a lot of these headline numbers that you guys have been seeing. And so we'll go ahead and jump into the first chart. Again, this is the Zacks Advisor Tools chart, and I've gone ahead and put them into a slide deck. And again, if you want to request this slide deck, I'm making it available this week in a newsletter format. It's going to have all my commentary in there as well. So I would suggest that whether you're a Zacks Advisor Tools subscriber or not, you go ahead and request that PDF. It'll have everything that I'm discussing in there, as well as all these charts. So again, 2 weeks ago, if you recall, we had a consumer spending report number for September 2021 that was up 0.7% from the previous month. Now, keep in mind, this is amidst the backdrop of supply chain bottlenecks, the COVID-19 Delta variant, and labor market fears. You know, this is consumer spending that has remained resilient. And just to give you an idea of how resilient that is, this is your 0.7 increase, right? This is that headline that made it 2 weeks ago. And you can see where we've come from pre-COVID, through COVID, post-COVID. This is just tremendous, right? So consumers have experienced obviously rising wages. We've got stimulus payments throughout 2021, and the consumers have more or less virtually shrugged off the end of the enhanced unemployment benefits as well as supply constraints, and they continue to spend and continue to push inflation to levels not seen in over a decade. And again, what I want you to pay attention to here is that current level, that 625 billion in consumption, that retail, trade, and food services. Again, retail sales. This is what you're going to see in the headlines, the 625 billion. So look at that trend. It's just tremendous. What didn't make the headlines, and I'm moving on to the next slide now, in the retail sales number that was reported for September 2021, was the fact that this is a 13.9% increase from the year ago September 2020 period. So all I did is I just literally transformed that chart in the previous view to a 1-year percent change. It's very easy to do that in Advisor Tools. The interesting thing I thought here when I saw this 13.9% was the fact that yes, it was elevated. Yes, it's literally coming off of 20-year highs, and it's still at 20-year highs. But the idea is that this is still a tremendous increase from its historical 20-year channel. So again, we're looking at a 20-year chart up here. You can see the recession period shaded in gray, and this is resilience. And I think the key here is that this is despite the supply and labor market disruptions that have impeded the ability or the availability of goods and services. So keep that in mind when you're reading these headlines. These are tremendous retail sales increases. When you see that retail sales was up 0.7% in September, the real story is that it's actually up 14% from the same period a year ago, and that really wasn't conveyed well by the media at all. Going on to the next chart, what we're going to do is we're going to take a look at a couple different measures of inflation. A lot of the publications, CNBC, Wall Street Journal, they always talk about this concept of CPI and PCE, less food and energy. You're going to see all sorts of numbers thrown at you in terms of inflation. And the ones that I like to look at are a little bit different than the Fed. The Fed obviously loves to look at less food and energy, but let's face it, right? We all buy food and we all buy gasoline, and those energy costs are built in. So, and we're experiencing it, so we need to look at it. And now we're starting to see this in the headlines, right? Consumer inflation in terms of the CPI increased 5.4% in September 2021. This is literally the highest year-over-year increase we have seen in over 20 years. And I want to make note that the CPI is produced by the Bureau of Labor Statistics. And again, this particular series that I'm showing includes that volatile food and energy category. And I just want you to notice that trend where we've come from pre-COVID, even look back at the highs during the Great Recession, or I should say pre-Great Recession. We are above those as well coming out of COVID. And so next slide, we're going to take a look at consumer inflation from the PCE perspective. And the PCE perspective, again, is going to be that preferred measure by the Federal Reserve once you remove food and energy. Ours on the screen right now, this includes food and energy. And the reason I'm showing this is it's very different from the CPI, but it's still at record levels. So you're going to hear people talk about inflation being up 5.4% year over year. This is an August read, right? So whereas the CPI, the most recent read, is September. So we've got a little bit of a difference in time frame here. The thing to keep in mind here is that these series are calculated and weighted just a little bit differently. So again, the PCE is produced by a different government agency. This is the Bureau of Economic Analysis. Okay, and again, regardless of what you're looking at, PCE, CPI, they are still at the highest levels year over year that we've seen in over 20 years, and that's the important point. So when we go to the next slide, I wanted to put these against one another just so you can see how well they trend. But I wanted to point out the differences. We do get these massive deviations from time to time, and they tend to occur on the outer bounds. And rather than trying to determine the actual factors themselves and exactly why these numbers are so different, it's better to just orientate yourself with the four general reasons or effects that could cause the CPI to be vastly different than the PCE. So I just wanted to take a quick second and review those. The formula effect, right? The index methodologies themselves are just a little bit different. So there's a formula effect. The calculation itself between the CPI and the PCE just a little bit different. There's also a weight effect. And if you think about this, it makes sense, right? Because the CPI is going to weight shelter, food, energy, other input factors perhaps a little bit differently than the PCE. Then there's the scope effect. And the scope effect is the measurement itself. So just one example could be for CPI, medical payments, so direct medical paid by consumers only. That's the only item that's actually included in medical for CPI, whereas PCE actually includes the costs paid on behalf of consumers. So that could be Medicare reimbursements, other insurance reimbursements. And then there's the fourth effect, and that's what we call other effects. And this is literally just methods of estimating timing for revisions and differences in seasonal type adjustment. Just realize that these two series track each other very well. So when you hear, oh, inflation is up 4.3, pay attention. Is it CPI? Is it PCE? And just note that those can be a little bit different. And also pay attention if it includes food and energy or excludes food and energy. Okay, but the important point here is what's happening with personal consumption and its growth as it pertains to the percentage of U.S. GDP. And this is something that I've been keeping my eye on because this is really, really empowering the consumers, right? The consumers are obviously in the driver's seat of the U.S. economy. And when you look at personal consumption expenditures as a percentage of U.S. gross domestic product, you can see, right, why that rise in consumer spending is literally sending demand shockwaves across service providers and manufacturers. And the key here is that these guys are already struggling with labor shortages and supply chain bottlenecks. And in the chart, you can see that current personal consumption expenditures as a percent of GDP is hitting 20-year highs at 69%. And again, what you want to note here is that this is the highest level of contribution to U.S. GDP we've seen in over 20 years, and this is despite supply and labor market disruptions impeding the availability of goods and services. So consumers are still finding a way to spend. Let's move on to the next factor, and that is the labor shortages, right? I mean, we've seen this in the Beige Book. We've seen it talked about every day, right? Doesn't matter if you read the Wall Street Journal, turn on CNBC, there's labor shortages are in focus. And maybe what hasn't been articulated well enough is what corporations and workers themselves are doing to basically combat it. So I want to shift the focus now to the chart on the screen, which is the U.S. non-farm labor productivity chart. And I went ahead and drew a trend line in here in Paint. I literally just took a screen capture and drew it in Paint. We do have trend lines coming in Advisor Tools shortly. But in the meantime, I've utilized Paint for that, so that's how I did it. You can see that U.S. non-farm labor productivity has been on a steady upward trend literally since that 2010 post-Great Recession recovery era. This latest era of COVID-19 has obviously ushered in a wave of technology, enabling work from home, and this is all going on at the same time we have labor shortages. And this has literally forced the remaining workers in the workforce to work longer hours at increased levels of productivity to meet consumer demand for goods and services. So as these labor shortages persist, businesses are going to be forced to adopt additional technologies and continue to raise wages and benefits to retain workers. But what I wanted everyone to see is just this regression trend. So if you're literally to run a regression against this series since 2010, again, this is a year-over-year percent change in labor productivity. You can see that we're on the upward slope, which is obviously a good thing. Okay. Next slide. When we take a look at new orders for non-defense capital goods, they are at all-time record highs as well. And I want everyone to, again, just take a look at this $77 billion in spending for capital goods. And again, this is going to exclude aircraft and defense. Obviously, aircraft took a hit during COVID, and we want to just keep it kind of to core capital goods spending. And when we talk about capital goods, I want everyone to think about goods that are required to be produced so that other goods and services can be more or less delivered or manufactured, if you will. So this is basically the materials needed to keep the economy going. And you can see that companies, they now have a growing incentive to invest in their operations again because labor is no longer cheap. So again, building off of this labor shortage concept, looking at labor productivity and companies going, you know what, it's not enough. Even though labor productivity has slowly been on the rise, we need to reinvest, and we need to reinvest heavily. And as a matter of fact, you can see that we've been pushed to 77 billion, and that is the latest read, and it is at record highs. And we expect this to obviously continue to climb as well. So the idea is that capital spending is going to give additional boost to the overall business productivity, and this is going to obviously serve to further grow U.S. GDP. The net result, obviously, is that we're looking at 20-year high net capital goods spending records, and this is expected to continue into the foreseeable future. So, what does this mean for inflation? Okay, and we're going to look at two different charts here. But what I've done is I've actually made available to you the 10-year break-even inflation rate chart, and that's basically the green line here that you see. And we've actually decomposed it into its constituents, right? So the formula that you're looking at is you take the 10-year Treasury yield, and that's going to be the black line, and you basically subtract the 10-year TIPS yield, and that will basically give you the 10-year break-even inflation rate. So 1.65 minus a minus 0.94 gives you 2.59. And the important thing to note is to look at this in terms of a longer-term trend. Now, this 2.59 is as of last Friday, 10/22. So this is a weekly series for us. And then when we shift to the next slide, we're going to look at this relative to a 20-year trend. And I've actually drawn some channels, but it's going to revert to a monthly series. So we're going to roll back to the end of September. And you can see that inflation expectation is 2.34. So we've actually risen up to 2.59, which is about right here now. But what I want everyone to see is that we are still in a very well-defined channel, range-bound, if you will, on 10-year break-even inflation rate averages. So again, what's that average inflation going to be over the next 10 years? The current bet is it's actually 2.59. And that's well within the range that we've been in literally for the last 20 years. So in summary, the increase in retail sales of 0.7% in September reported 2 weeks ago was simply the tip of the iceberg when it comes to explaining what is really going on beneath the macroeconomic landscape. There is much to be optimistic about as we prepare to usher in 2022, but supply chains, labor shortages, and Fed misstep risks remain prevalent. Today, we look at the impact of consumer spending beyond the Fed Beige Book to look at how it's impacting consumer prices, personal consumption relative to U.S. GDP, labor productivity, new orders for capital goods, and the 10-year break-even rate, inflation rate expectation. As consumer demand remains resilient in the face of COVID variants, labor shortages, and supply chain disruptions, U.S. corporations are reinventing their businesses at the highest rate in the last 20 years. Capital expenditures will continue to rise as companies now have that growing incentive to invest in their operations again because labor is no longer cheap. The strength in consumer demand is pushing personal consumption expenditures as a percent of GDP to 20-year highs and is setting the stage for overall business productivity to continue alongside labor productivity, both of which will contribute to overall U.S. GDP growth in 2022. So again, I want to remind everyone that Fed Beige Book does an excellent job at gathering this anecdotal information on current economic conditions. However, I encourage you to take that next step, just like we did today, and put these pieces of the puzzles together to formulate your own economic outlook as we prepare to head into 2022. I hope the charts I've created, the analysis I've prepared for you today helps you formulate your own perspective. Again, I've gone ahead and placed this entire analysis with my commentary and the Zacks Advisor Tools charts in a newsletter PDF, you're more than welcome to request a copy. Just go ahead and send us an email or call us. So that's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn and I'm on Twitter at Tim Nyland. If you're interested in getting started with Advisor Tools or ZRS, or if you're looking to upgrade your current subscription, please contact our world-class support at advisortools@zacks.com and ZRS@zacks.com. Thank you for watching, and I'll talk to you all next week.